Now, I want to also, Ed, pull up, you bought me this piece of paper today, and it has 4 scenarios on it. One of them is chaos. Chaos defined by financial crisis, treasuries, USD, safe haven status collapses, war, and a Chipotle bankruptcy. I assume that part is a bit of a joke. But when you think about the probability of outcomes, particularly the most dire ones, what is it?
I think when it comes particularly to Treasury market functioning, we've had a lot of yellow flags go up in the course of the last week. We're still not at a level where the Fed will intervene. And I think the good news is we have the toolkit. We've used it in the past. We used it after the COVID crisis. We used it after Silicon Valley Bank. And of course, in 2019. So the toolkit is there. What's the threshold for the Fed to use it? We're not quite there, but I think we're definitely quite close.
You know, Mike, what do you think the biggest reasons are to worry about further sell-offs in the Treasury market at this juncture? There are a huge range of reasons, but I'll take 2. A foreign buyer's strike being one big risk that people are talking about, and leverage in the system. That was something that Treasury Secretary Scott Bessent earlier this week said was an issue to the earlier part of this unwind. Moving forward, what's going to be the cause if we see one?
I think those are absolutely 2 of the key causes. I think the third, which of course Bessent did not hit on, was long-term inflation expectations really skyrocketing. Listen, you probably still have, quite frankly, if you go into a huge growth slowdown, 5, 6, 7% unemployment, negative earnings growth, et cetera. If that were to happen, later this year, next year, whenever, I still think treasuries will be the safe haven asset. However, when I look out past 10 years, you look at the 20-year, you look at the 30 years examples, they're probably not going to rally nearly as much as in past cycles. And so the reason for that, we have the deficit, of course, but I think it's really the long-term inflation expectations, an inflationary impulse through tariffs and deglobalization and a change in demographics that the market's really waking up to. So for me, it's that inflation component that's really going to be that third component.